Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 5th, and welcome to the In the Know Trader show on StockCharts.com. The S&P's having another good day. It's up about 45 points as we record this at just near 2890 or so. So it's right near the highs of the day as investors are once again enthused about potential openings across the country, and they're back in kind of full buying mode. We've got crude oil up over $3 today. Gold is taking a hit as some less fear reduces its price by about $8. And the 10 years trading at about 65 basis points. We'll take a look at those. So today we'll look at a bunch of different markets. We'll do a trader education segment on setting realistic price targets, which are extremely important when you're trading. And then we'll also take a look at the Dow Dogs. Well, these are the 10 worst performing Dow stocks in the last 12 months. Boeing, Exxon, Travelers, American Express, Cisco, Disney, Chevron, Walgreens, Caterpillar, and JP Morgan. Take a look at those charts and see how they look now. A lot of times Dow Dogs actually become much better over time, and we'll take a look at how these worst 10 of the 30, what their charts look like to see if there are potential opportunities there. To get S&P bond, gold analysis, etc., key support and resistance levels, and my thoughts, most especially about what to do in the markets, along with a new ETF trade each week, you can go to my website, intheknowtrader.com, and sign up to become a subscriber, where you'll have far more detail and actual trading strategies and what to do across these markets. To contact me, it's rick@intheknowtrader.com. And thank you for the emails and how many people each week write me and tell me how much they learn from these weekly shows. And I am glad that you're learning from it. And that is my goal, is helping you become better traders. And it's actually the whole reason I created In the Know Trader in the first place. For those of you who have listened to me before and know anything about my background, I really spend the bulk of my time consulting to the institutional community. But 2 years ago, I decided to start In the Know Trader to give the individual investor access to models and the way institutions look at markets, which is very different than how the individual investor, also known as the industry would call the retail investor, looks at things. And the models we use are very different than most of the models that people would use. And this gives you a significant edge in the market, because you do want to be looking at markets the way institutions do, and not the way necessarily a textbook about, let's say technical analysis, or, the way the average person looks. I can tell you that most institutional traders are not looking at, overbought or oversold RSIs and making big decisions on them, or necessarily crisscrossing moving averages. Kind of intheknowtrader.com as far as information to sign up. Let's first take a quick look at how the S&P macro sectors are doing this year. Your best performer is still technology, outperforming the S&P by just over 10%, followed by healthcare up 7%, almost 8%, let's say. And then you've got communication services up about 4.5%. Energy sector remains the worst sector by far, but it has rallied admirably in the last couple of weeks. It was down about 35% versus the S&P, if not even a little worse than that. It is now only down about 25.5%. And then second worst are financials. Again, they tend to do poorly when interest rates are low, and you've got a bond market that's kind of sitting in and around 50, 60, or 70 basis points on the 10-year. And because of that, banks have a hard time making money, and that's why financials are underperforming. And then industrials are the third worst, down 12.5%, as they are very cyclical and related to the economy. And of course, with the economy more or less closed down still, it's not a surprise to see them underperforming and to be one of the worst sectors. So that's a look at that. Let's take a look and kind of move to our market overview. So we are going to switch to our charts. We'll start off with the S&P here. We have far more details on how to play this in the No Trader each week. But just in general, I've kind of identified north of 3,000, that pink highlighted box above current. And that's a general area for selling. The green box underneath, which is less just beneath 2,600, is kind of my preferred buying zone, and everything in between there is, which is, look, a 500-point range in the S&P is in between those boxes, and that is a rather significant range. But in between there is pure trading, whereas in those highlighted zones are where I want to do more kind of portfolio shifting. So it would still be a seller on strength and a buyer on weakness, and that's my general thoughts on the S&P. Let's take a look at the 10-year. So here's the TNX. So this is obviously the yield on the 10-year. It's not the price of the bond, it's the yield on the US 10-year Treasury. And I've drawn a purple. So we have pretty much equal lows. So other than the day that made the lowest low, subsequent lows have stopped at about 56 basis points. The next day after the lowest low, the next day's low was 56 underneath it, but closed just about at 57 basis points. You can see we've got a base here. And you've also got still the downtrend. So you have a descending triangle right now, still within the context of a building pattern. My guess is, just based on, let's say, DeMarc's propulsion signal, you need to get above 76 basis points to up the odds that you can then get towards the low 90s and then the higher 90s. So that's otherwise kind of, there's not much to do here. On a break underneath, it opens up the door to potentially test the lows, if not even head lower down towards 30 or 20 basis points and so on. And this is the quagmire in the bond market, is whether or not the US 10-year heads down towards 0%, the way many other places in the world still are, or whether or not, seemingly there's something important here somewhere around 55 basis points that continues to find sellers show up in the bond market, which means buyers in yield terms, looking at the chart of yield as if you buy or sell them in yield terms. So we're not doing anything right now here, but just kind of waiting for this pattern to resolve itself. Let's take a look at the GDX. I think this is a very important chart. We've been looking at this for quite some time, and you have a peak in 2013 at around 32. You had a similar peak in 2016. You had a similar peak in 2019, and then again earlier in 2020, just before the markets got crushed. So even gold names fell off marching into early April, just on a general risk-off move, and then they came screaming back and pushing out at new highs. You got to kind of think, when you look at this, that this move not, and then the truer picture has come into view here, which is the breakout to new highs. And this would make me think that you still generally would like to be long this group by weakness. And you would think that if it pulled back, that this zone in here, so into the high 20s, should act as support, and that you really shouldn't get beneath there, given this breakout that we've had. So I don't mind if we pull back to the 32-ish level. I don't even mind if we pull back a little underneath. I don't think you'd want to see this get beneath, let's say, 29-ish, give or take. 27-ish, give or take. That's about the most I'd be willing to see this pullback. And on the upside, if we bring in some more years of data, you'll see just how much there's room that this can go. So if you think of this move, the breakout here, perhaps being similar and to what the gold chart looked like, which was a 6-year rounding bottom, and then the breakout to the upside, then it's very possible that gold, the scheme of potential return versus the risk here, I like this sector, and I think it's a place that you want to have exposure in your portfolios to gold stocks, and perhaps even more so than to gold itself. What else did I want to look at here? Let's see. Oh, let's just quickly bring up this chart. This is the XLE. First, I'll switch it to a monthly, and then we'll turn it back. So this is the all-time trading history of the XLE versus the S&P. And you can see that at the beginning of this year, we actually crashed to new all-time lows, again, versus where the low had been since XLE started trading. Now, the S&P Energy Index was calculated long before the XLEs and all these spider ETFs came into being, but this is at least the history we have. So we made new all-time lows since these spiders came about, but we've bounced nicely recently. And in fact, even if I switch it to a daily chart, right in here is where I had told institutional investors to consider energy as a sector to bring back to minimally be an equal weight, and so no less than an equal weight. And obviously, it's done very well now. It's outperformed the S&P. So if the ratio of the XLE was at 11% of the price of the spider, and now it's just over 13%, you've captured about 18% return as a pair trade. Now, I'm not suggesting people necessarily buy XLE and short the spiders against it, but what this does suggest is that energy can outperform. And finally, it's still a small piece up considering the historical damage this has had. This is a small piece right now, but look, in the past, in 2018, we saw a good run that lasted over 6 months, or just let's see, no. Now that I think energy was the right place to come back to also. So that's been working. And if I'm not mistaken, I mentioned that at least 2 weeks ago in the show. So you had a chance to partake in this too. Basically, meaning you wanted to come back and buy some energy names, and that they do at least as well as the S&P, which is not something they've done for a heck of a long time. Okay, now that's our market overview. Let's the educational portion here. I wanted to talk about setting realistic targets in your trading, and I think this is, before we even look at the chart on it, let's just talk about this conceptually. You do your homework to figure out when to finally step into a trade, and let's just, for argument's sake, let's say it's to buy a stock or an ETF or something, because most people are buyers. So you put all this time in doing research to figure out when you're finally going to come in and buy something. And often that's where the analysis ends. And what you're not thinking about are the questions that are very important, which are a combination of, where does the market trade down to and prove me wrong, in which case I should not be in this idea any longer. So in other words, essentially developing a strategy for a sell stop, and that's even more important than setting a target. But you've got to set realistic targets when you put a trade on. You can't simply buy something and say, okay, we'll buy this, and have no clue on where you would potentially lighten up. Unless you are a long-term investor and you're buying a stock either because your brokerage firm suggested it or you've done your own research and you say, let's just say I'm going to buy Apple and I think this is a great company. I'm going to hold it for years, and you're not looking at it with any consistency about where it's trading and where it might run into trouble, et cetera. But you're just buying this saying, okay, I'm a long-term holder. I'm going to hold this puppy for 20 years. And I suspect that in 20 years from now, it'll be well higher than it is now, unless you're in that camp. But if you're anyway a sense of a trader, and I suspect you must be to some degree because you're listening to this show and it's called In the Know Trader. It's not called In the Know Investor. It's called In the Know Trader. And that's because we're basically trading markets. Now, I'm not suggesting in the work we do, we're not day trading. We're not looking to buy something on a Monday or sell it out that following Thursday. We're basically looking to hold stuff weeks to months. And when you're in that type of realm of time frame, you need to have realistic targets, because when you get to those targets, you essentially need to take an action. And usually that action would be selling at least half of what you first put on. Many times when I hit my target, I take everything off. Doesn't matter what the chart looks like at the time. Because look, when you rally to your target, the chart's going to probably look pretty good because you've been rallying and you bought something lower and you're feeling good that you made money. That's good and all well, except that if you did your homework, you also knew that and said to yourself at the inception of the trade that if it gets to, if I pay X and it rallies to Y, that's what I'm thinking I should get on this trade. Well, when it gets to Y, don't go, maybe it looks like it can go to Z now, which is even higher. Maybe it does and maybe it doesn't. But to me, you've got to take off at least half when you hit the target that you intended. Because if you don't, and the stock turns around and goes down from your target and you've done nothing, this will psychologically do more damage to you than it'll hurt your pocket. And it'll probably hurt your pocket because you gave back profits, but it'll hurt you more psychologically. And as a trader, having good psychology and kind of healthy thoughts about how you approach things in life and how you trade is really important. So you don't want to do things that take away from your belief in yourself as a trader. So if you pay $25 for a stock and your target's 30, when it gets to 30, I suggest you take off at least half. Because if it pulls back down to 26 and you did nothing, you'll be kicking yourself. If it pulls to 28 and you've done nothing, you'll. So if you bought a stock and you get to your target, take a good amount off. If you think it can go well through 30, fine. You either put it back on or stay long the other half that you still have. That's fine. But by taking profits, now if it trades off, you still have the chance for a win. And even if you get stopped out back where you put it on, you've still made money. But if you do nothing when you hit your target and now it came back to where you put it on, now you've got, at best, a no gainer when you had a decent gainer. So to me, the odds always line up with taking profits where you intended to take them. And if you want to play with a smaller piece of that trade, that's fine. Because now you kind of have, quote, a free trade on. You can, at worst, get out where you got back in. You'd still walk away with money. But think about what happens if you've done nothing. Now, just to finish this off before we start looking at a chart and trying to just get a sense of how to set targets, let's say you sold half and it keeps going. And you go, I can't believe I sold half at 30. Now it's 35. Now it's 40. Well, I look at it as just because you sold half doesn't mean that you can't put that half on if you've properly broken above that resistance area that you initially set as a target. And or it still means you have half on and you're writing profits on the rest. And then you're raising your sell stop and you're protecting these profits so that if it gets to 35, now say if it gets back under 30, it shouldn't get under 30 because it broke above resistance. So maybe you set your sell stop at 29 and a half now, protecting profits, and let it run. And if it goes to 40, then raise your sell stop again. That's what trading is. That's the difference between trading and investing. So let's just take a look at, you really have to think about this as you're playing this game, because it is a game you're playing. It is not investing, which says I have a 10, 20, 30-year time horizon, and I just know over time, markets move higher, therefore I'll take those chances. Here's the gold chart. This is actual gold futures. Right here in the middle of the chart is the all-time high at 1926. So here's that 6-year rounding pattern. And it broke out from, you can pick any one of the purple lines you want, but this is kind of where the pattern broke out to the upside. And it looks similar to what GDX looks like now. And it breaks out. So if you had bought this breakout, I'll pick the middle line at 1375. I know I have certain targets in mind. And my first target zone that I had for institutional clients was this zone in between the pink lines. How did I come up with them? Well, it's a realistic target. I looked at kind of, where did gold break down from? Well, it broke down, clearly it broke down from this line. And the last high it made before the breakdown was this high here. So this to me creates a zone in which I took half off. And at the time, look, I take some off, it pulls back. I'm feeling good that I took some off. It now rallies and gets to the top end. And I've scaled out in this area, and now it pulls back again. So when gold gets down to 1450, and I've sold some, let's say north of 50, or average price 1550, I'm feeling pretty good that I did something. By chance, having not to do with just this, I re-upped my long at 1455. We actually told clients a week before we got here that if gold got down to 1460 to 1450 to be a buyer. And we're still long half right now. And I'm debating what to do, because the high of the move got to pretty much these other highs. But I moved up my stop, so I can't lose money on this trade. I'm kind of thinking 1660-ish, which is just below last month's pullback. Got to April, we actually pulled back to, I think it was 1667. So just beneath there, so it's kind of a level I'm thinking about. And this month so far, we got down to 1676. So I know the pullback in April got to 1667. I know the pullback this month got $10 higher to 1676. If we get beneath this, I might kick it out, and then I think about where I could put it on again if it keeps going higher. But clearly, it's having trouble up in the upper 1700s. Stock markets come back, and therefore, I need to think now, if I want to hold what I'm long from down here, because I think gold's going up to, $2,000, $3,000, and $4,000 over the next few years, then I may take a piece of what I still have and make it, okay, maybe a quarter of what I initially put on, I'm going to hold for the big move higher. But this is, setting realistic targets is the smart way to trade. And I have to put the whole picture into consideration. Is a 6-year rounding bottom that breaks out to the upside only going to stop a year, not even a year later? Or might there still be more to go? And so I'm not saying that there aren't elements to consider in this. But if I'm trading and I'm not investing, I need to think about where are levels that make sense to take profits. And that's what I do. So I add, I take off, I add, I take off. Commission is free these days. I don't care about that piece of it. It's just a matter of hopefully that anytime you sell, that you buy back lower. But it's not always going to work that way. But again, if we had gotten up to this green line was the measured move from this whole rounding bottom. The whole rounding bottom was a $325 move. I added $325 to the 1375 breakout. That got me $1,700. So, we went to 1,700, and then since there, we got as low as 1576. So that's $150 move. That's a fair amount. So you've got to kind of put all this, and this is just gold, but in anything you're trading in any time frame, you've got to set realistic targets as a trader and play off of that. That's today's trader education. Let's now get to, we've got about, I don't know, 4 minutes left or so. Let's get to a bunch of charts during that time. Let's start with, here, Boeing, worst performer. Um, so the lows that we made in early 2020, on the March lows when everything fell apart, we basically tested the 2016 low. We rallied nicely off of that, got from under 100 back up to just over 180. But obviously, Boeing's had trouble. And then even with Buffett's comments about airlines, now this is an airline maker as compared to a flyer, but it's obviously going to be affected by what's going on in the economy and the problems that Boeing has itself. So my thought here is that this line here from the cloud chart is still going to be potentially resistance, and it's going to keep falling if we can't progress here. So look for that as first resistance. Over time, if it got back to 230-ish for the next year or so, that's going to be an important level. And obviously, if we get back underneath 100 again, this thing's really in trouble. Exxon. Good bounce off the lows. Again, crude oil's bounced, the market's bounced, but take this chart, you go back a few years, it's a terrible looking chart. It's going to be very heavy. There's only so far and so much you would expect. Look here, triple bottom from 2006, 2008, 2010. Best chance you're going to see here is probably a move back to the mid 50s. This is pretty much a broken chart and clearly not a long-term hold anymore. Travelers. Breaks, cloud model had worked for a long time, breaks. This is also what's an upside realistic target, somewhere in here where the double bottom was. We didn't get far from there on this year's bounce. Going forward, same type thing. Anything north of, we'll say, 110 into the 125 range should be major resistance and not a particularly good long-term looking chart. American Express, another dog of the Dow. Not as bad looking simply because here from the 2008 low, you pretty much held this on the decline. But it's actually now a little above the conversion line, first level resistance. But it's going to have some type of resistance also just from this double bottom. Tough call here. I would say if you're a bull, you buy weakness because basically your long-term trend held. Cisco. $2011 low to 2016 low. We held above that. You've got a fairly sharp downtrend here to deal with. My guess is anything into the mid 40s acts as resistance, a fair amount of trap buyers. There's a rounding top, There's a head and shoulders in here with, looks like two left shoulders and maybe two right shoulders that broke. The neckline is not exact, but I don't know, maybe it's something like that. I would think anything in the mid 40s is going to be resistance. You've got a few years worth of trap buyers there. Disney. So we took out this low here, held above the 2000, actually went right to the 2014 low. So the big breakout in Disney has all, a year's worth of buyers trapped. That's going to put some lid on here. I would think if this thing got back to 120, 125, it's going to find trouble. But we didn't get to all 10 of these. We got to about half, and that's going to be it for this week. Thanks for listening. I'm Rick Bensignor, and this is In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.